evidence, right? So this event occurred after the what 31st December. But then during the period, during January to December, they had some conditions. There was some evidence which showed that, oh, these events are likely to happen in the future, right? They are likely to happen in the future. So that is the adjusting event. That is the word adjusting event. So what do we do to the adjusting event? When we get an adjusting event, we have to go back. So we see it occurred after 31st December. We cannot say that, oh, we have already prepared the financial statement and therefore we cannot go back to correct that error. So we have to adjust the financial statement because the events are what adjusting events and they are very material. So adjusting events are very material and can have an impact on the financial statement. They are material and can have an impact on what on the financial statement. So you have to go back and what adjust them. So what are some of the examples of the adjusting events? So let's give some example so that it becomes easier to understand. Let me give some examples. So examples of adjusting events. What are some of the examples? Example, bankruptcy of a major customer. Bankruptcy of a major customer. Bankruptcy of a what? Major customer. So what do you mean by bankruptcy of a major customer? So when the one of your major customers goes bankrupt, I'm sure bankruptcy does not just turn up one day and then the customer does not just turn up one day and see and then goes bankrupt. Definitely there will be some kind of reactions. There will be some kind of evidence, some kind of signs that will tell you that, oh, what is happening? It is likely that this customer might go into what? Bankruptcy. It is likely that this customer might go into what? Bankruptcy. So when this customer goes bankrupt, so you might see from the trade receivables in your financial statement, not the current asset, that this particular customer is not trying to pay their debt. You see, the debt has been in the trade receivables keeps increasing. So that there is a loss at the reporting. Why? Because there's a particular customer who is not paying his debt. You go to the house, he'll give you stories. So there's an evidence of its existence. There is a sign in the financial statement from January to December. There is some kind of sign here which is showing that this customer is likely to go bankrupt. So if at the end of the period, after the period, this customer goes bankrupt, then it is an adjustment event because during the period, under current asset trade receivables, we can see that there is, and the trade receivables keeps increasing. And when we investigated, we realized that one of the customers is not paying its debt, and because of that, as a result of that, we are making some loss. So you see that there is some evidence, some condition existed earlier, and that is telling us that this event is an adjusting event. Do you understand?
Yes.
All right. So that is the first example. And the second example I can give is settlement after reporting date. Settlement after reporting date. of a court case. Settlement after reporting date. Settlement after reporting date of court case. Of court what? Case or cases. Of court case or cases. So settlement of what? Of a court case, right? Or a court case. You see that this is also an adjusting event because court case does not just take one day for you to go to court and then the judge will just rule that, oh, party A won or party B won. You see that court case can cross over years, right? It can cross over years. It's not just you can be going to court for like 10 years and you are still going to court over a particular issue. So you see that it could be that during January to December, that's where you started the court case. And then, unfortunately, the judge did not rule on the issue, on the matter. And then it escalated into the next following year. So you see that, and then in the following year, in the between the December to March, you see that the judge gave a judgment, right? The judge gave a judgment that, oh, party A, party B won. So you see, maybe the judge gave a judgment that we the entity, we have lost. As a result of that, we are paying an amount of $10,000. So the judge ruled that our business, we are a friend said we lost. What is the name given to that? When you lose a court case, what is the name given to that? That is it? Oh, all right. So yes, I believe you understand. So when you lose court case, so we have lost, and as a result of that, we have to pay an amount of $10,000. So this $10,000 would have to affect our January to December figures. Why? Because evidence existed in between January to December. There was an evidence. There were some conditions because the court case started from January to December, right? So if after December that they are ruling, the court is ruling that we have to pay some liability, then this becomes an adjusting event. The third example that I can give is the sale of inventory. Sale of inventories. Sale of inventories. Sale of inventories. So sale of inventories. Let me say. Sale of inventories after the reporting period. After the reporting period. After the reporting period for less than its carrying amount. Less than its current amount or value at the year end. At the year end. So during January to December, we had an inventory of 20,000. Now after the year end, we sold this inventory. So this is the carrying amount in the books. This is the carrying amount in the books. Inventory 20,000. After December 31st, we sold this inventory for, let's say, 14,000. So this is the recoverable amount. Recoverable amount or the net realizable value. The net realizable value. So we are saying that this transaction needs to be adjusted. It's an adjusting event Why? Because in our books we had an inventory of 20,000. Now we sold it for 14,000. Are we making a loss or are we making a profit?
Alright.
A loss. You see that we are selling it lesser than the carrying amount. So this thing has to be adjusted in the what? In the books. So it is what? An adjusting event. It is an adjusting what? Event. So if you understand the meaning of what an adjusting event is, you'll be presented with some transactions and you have to determine whether it is an adjusting event or non-adjusting event. So by the definition, you should be able to identify, no matter the type of transaction that you are presented, you just analyze the transaction and tell whether it is an adjusting event or not, right? Whether it is an adjusting event or not, right? So now, this is the recoverable amount. So this amount needs to be what? Adjusted in the books. So um that is the sale of inventories lesser than their recoverable amount. Lesser than their recoverable amount. Lesser than their recoverable. Another example that I can give is um, let me see, a decrease in the value of long-term investments. So decrease in the value, evidence of permanent decrease. So let me see, evidence of permanent decrease, evidence evidence of permanent evidence of permanent decrease in the value of what? A long-term investment, long-term investment prior to the year end, right? So um, when we were in January to December, we anticipated that there will be a decrease in the value of the long term, right? So let's say a long-term asset, right? So you are using a machine, and then the machine definitely, as you are using it, it will depreciate, right? The value of the asset will fall, right? So you see that when it falls, maybe during after the period, you have to go back and adjust it, right? So that is an adjusting event. That is an adjusting event. That is an adjusting event. One of the adjusting events is also dis- discovery of fraud or error. Discovery. Discovery of fraud or error. If you see fraud error in a particular transaction, just know that it's an adjusting event. We can't overlook fraud. We can't overlook fraud or an error. We've made an error is when it's unintentional. An error is what? Unintentional. But then fraud is intentional. So these two we cannot overlook them. So these two are what? Adjusting events. So um discovery of fraud, discovery of fraud or error, discovery of fraud or errors. That shows the financial statements were incorrect. That shows that the financial statements were incorrect. Incorrect. Right. All right. So these are basically some examples of what of adjusting events, right? So bankruptcy, or let's say insolvency, insolvency of a major customer, insolvency of a major what customer. All right. So now let's move on to the non-adjusting event, non-adjusting event, non-adjusting event. So non-adjusting event. What are non-adjusting events? What are non-adjusting events? So non-adjusting events are the events that occur after the reporting date. So note that both of them occur after the reporting date, after 31st December. Example, that is if the company is using January to December. It is not every company that uses the basis period January to December. Some varies, right? So if they are using January to December, then it means that all the events that occurred after the reporting date, which is after 31st December, non-adjusting events also occur after the reporting date, but then there existed no evidence, no evidence or no condition in the basis period, right? No evidence or no condition existed during the reporting period. During the reporting period, right? Mhm. And with non-adjusting events, with non-adjusting events, they are usually non-material, right? They are non-material. When you say something is material, it means it is significant. Its omission in the financial statement would make a great impact, would have a great impact. So that is when something is material, right? Material. So non-adjusting events, you see that they are events that did not show any evidence. So the keyword is they did not show any evidence. They just came after the reporting date. Those things are something that just happened. So something like fire outbreak, something like a misfortune, a natural disaster. Those things are non-adjusting events because during the accounting period, nothing showed. There is no evidence that there will be fire outbreak, that there will be an earthquake. So all these things are what are non-adjusting events because they had no existence. They had no evidence of its existence in the accounting what period, in the accounting period. So usually when they are material like this, we disclose, right? So if the non-adjusting event is material, you have to disclose it. You disclose it in the financial statement, right? In the financial statement. So disclosure is like writing a note. Note. I believe when we were preparing the financial statement, we saw something like note one, footnote one, footnote two, footnote three, the additional information. You have to disclose it that additional information one. Um, there was a natural disaster during 2nd February 2025, right? So you disclose it in the financial statement, right? But with the adjusting event, you have to go back and adjust it. So that is the difference between adjusting and then non-adjusting what events, non-adjusting events. So conditions did not exist at the financial position date or at the financial statement date. No conditions what existed. So this one you have to disclose it by way in the note, in the note, in the note. So let us look at some of the examples of the what of the non-adjusting events. Examples of the non-adjusting events. Examples of non-adjusting events. Examples of non-adjusting events. Non-adjusting events. All right. So one, I can say that a major a major business combination, a major business combination, a major business combination after the reporting date. After the reporting date, a major business combination after the reporting was date, or maybe a disposal or disposal of a major subsidiary of a major subsidiary. When I say subsidiary at your level, you might not know what it is, but level 400 would know what a subsidiary is. All right. So you are just after the financial reporting date, you acquired another business. Just after the financial reporting date, you acquired another business. So let's say S&A Limited. We were having our financial statement that are January to December. Just after the 31st December, we acquired a subsidiary, which is um, a subsidiary known as ASA, ASA Limited. So S&A acquired ASA Limited. So ASA Limited is under we. So now, if we are preparing our financial statement, now our financial statement will be S&A Group. S&A Group. It will not be S&A Limited because we've now acquired another entity. So now S&A Group. So this S&A Group has ASA information in it because you have acquired it, right? Yeah. So we are saying that when a major business is acquired, that is what that is not an adjusting event because that there was no evidence. So what is going to guide you is the definition. There was no evidence of its existence. There was no condition of its existence. Therefore, it can't be classified as an adjusting event. It can't be what classified as an adjusting what event. Adjusting what event. Please, are you with me so that I know whether maybe um I'm with you so that I won't be just talking in the air? All right.
Yes.
Okay. So that is the non-adjusting event. This is one of the easiest topics, one of the cheap topics or cheap standards. All right. Okay. So this is first example. So a major business combination. So after this, we'll solve some questions and then you would appreciate it. Then we can talk of maybe announcing a plan after the reporting date. So like you are announcing a plan, you are announcing that you do something. So announcing a plan after the reporting date, announcing a plan after the reporting date, announcing a plan to discontinue an operation, to discontinue an operation, right? So that is also a non-adjusting event and it's self-explanatory So destruction of an asset by fire. So any natural disaster, right? Destruction, destruction of assets, destruction of assets by fire after the reporting date, right? By fire after the reporting date. Let me add it. After the reporting. So everything is after reporting date. Everything is what? After reporting date. Everything is what? After the reporting what? Date. After the reporting date. After the reporting what? Date. after the reporting what date. After the reporting what date. So and also we can talk of maybe foreign exchange, changes in the foreign exchange. Let's say now during 31st December, after 31st December, the exchange rate was 8 cedis. Now the exchange rate is, let's say, 12 cedis. So you see, you cannot make adjustment um, to the previous 8 cedis in the financial statement. That is a non-adjusting event, right? So large changes after the reporting date in the foreign exchange. So large changes after after the reporting date, after the reporting what date, after the reporting date, after the reporting date in foreign exchange, what rate, in foreign exchange what rate. Then we can also talk of equity or dividend, equity dividend. When you declare dividend, equity dividend declared, equity dividend declared or proposed, or proposed, or proposed, or proposed after the reporting date. Proposed after the reporting date. All right. So these are some examples of what the non-adjusting what events, non-adjusting what events, non-adjusting what events. So there's an exception to this. To this, there is an exception to this. There is an exception to what to the non-adjusting event in terms of going concern. The going what concern. So what is the going concern? The going concern is like as a business, we anticipate that the business would continue to operate for the foreseeable what future. For the foreseeable what future. The business is going to operate for the what foreseeable future. It is what a going concern. Going concern is what we are anticipating that the future would the business will continue to operate for the unforeseeable future. For the unforeseeable future. So let's say just after we prepare the 31st December our financial statement, then the business decide to exit or the business decide to cease to operate. Let's say after 31st December, 5th January now the business decides to cease operation or they decide not to operate again. What are you going to do? Are we going to adjust the financial statement or we are not going to adjust it? So um this principle is having an exception with respect to the non-adjusting event. Because we would have said that no, there was no evidence, so we shouldn't adjust it. But then this going concern um it's no longer what appropriate. It is no longer appropriate. IAS 10 state that there should be a change in the fundamental basis of accounting. So you have to change the basis of accounting because we are using the going concern. The going concern is saying that the business will operate for the foreseeable future, right? For the foreseeable future. So we have to change it. We have to change the basis. So we would be using the breakup basis, the breakup, because we are not continuing to operate. So we would use the breakup base, and then we have to disclose it in the financial statement. We have to disclose it. So in accordance to with IAS 1 presentation of financial statements, management would have to disclose any material uncertainties relating to events or conditions that will have an effect on the continuity of the business. That will have what an effect on the continuity of what the business. All right. So that is that. That is that for event after reporting period. We are done with IAS 10. So now when someone asks you IAS 10, you have done IAS 10, and you can explain to the person what IAS 10 is about. IAS IAS 10 is about events after the reporting period. So without wasting more time, I think I posted some questions in the group. So let's look at this.
Question 1. The following material events have occurred after the reporting period and prior to the date of approval of the financial statements by the directors. I. The insolvency of a major credit customer. II. The uninsured loss of inventory in a fire. III. The proposal of the final equity dividend. IV. A change in foreign exchange rate. Required. State whether the above are adjusting or non-adjusting events.
So is it an adjusting event or non-adjusting event? It is an adjusting event. Why? Because the insolvency of a major credit customer. I said when the customer is not able to pay its debt. So we see that in the financial statement, there would be some kind of signs, some conditions would exist that would inform that this customer is facing some challenges, right? So there will be some kind of, so when you look at the trade receivables, you see that the trade receivables figure is big. So you can tell that after investigating, you realize that there was one particular customer who has defaulted his payment for the past month, right? Who has defaulted his payment. So this sign is existed during the financial period, right? During the financial reporting period, right? So it is an adjusting event. Why? Because there existed some evidence of its occurrence, right? I believe you are fine. One is the uninsured loss of inventory in a fire. So is it an adjusting event or non-adjusting event? Non-adjusting event. I said that non-adjusting events usually they are natural disasters, right? What of the third one? The proposal of a final equity dividend. The proposal of a final equity dividend. Is it an adjusting event or non-adjusting event? So if dividends are declared after the reporting period, those dividends cannot be recognized as liability, right? I'm sure dividend payment is a liability to the entity, right? Dividend payment is a liability, all right. So when are dividend declared? Dividend are declared after the financial statement, right? After the statement is prepared. That is after we have after 31st December, we have finally prepared everything, and then that's where we will declare dividend, and then we'll pay the dividend to the respective shareholders, right? So this occurs at the end, right? It occurs after the reporting period. So we cannot classify this as as um as an adjusting event because it happens every year. And then you were making some example that interim dividend, they paid interim the part of the interim dividend during the period, and that they are expecting to get the rest at and they're expecting to get the rest after, right? Yes, and you know that we can decide actually not to pay them dividend. You know that we can actually decide that at the end of the period we will not pay them dividend. So it is something that is uncertain, right? It is something that is uncertain. Even the dividend amount, you don't know the amount that they are going to pay you, right? So it is something that is uncertain. Change in foreign exchange rate is an adjusting event, non-adjusting event. Something is about principles. What does the rule say? Rule say that if evidence existed, it is an adjusting event. If evidence that did not exist, non-adjusting event. Simple. It's about principle. If you are not disciplined, you cannot um, read accounting. So this is the first example. Now, second example, illustration 2.
S&D Limited and in 31st December 2020. In February 2021, a major receivable went into liquidation limited year ending 31st December 2020. In February 2021, a major receivable went into liquidation and the directors believe that they will not be able to recover the 450,000 owed to them. How should this item be treated in the financial statement of S&D Limited for the year ended 31st December 2020?
All right. How should this item be treated in the financial statement? So say S&D Limited year ended. So here, take note of the date. So the date is what? The date is 31st December 2020. In February 2021. So to 2020, right? And then February 2021. February 2021, a major receivable went into liquidation. Receivable is what? It's talking about what? Trade receivables, right? And they went into liquidation. And the directors believe that they will not be able to recover the 450,000 owed to them. So it's a bad debt, right? So how should this be accounted for? It needs to be adjusted to the financial statement, right? You can say that the customer's financial difficulties would have existed. But here they said that a major customer receivable, right? So this the major customer's financial difficulties, the major customers or receivables, receivables or customers financial difficulties, financial difficulties, financial difficulties would have existed. So it would have existed because it was 31st 2020, right? And then since the major customer went into liquidation, there would be some signs. You don't just wake up one day and then you go into liquidation. You see, there will be some kind of signs that would inform that you are facing financial difficulties. So the receivables of major customers' financial difficulties would have existed, existed at the end of the year, right? At the end of the financial period. So at the end of the financial period. So at the end of the financial period, right? Even if the company did not know about it, even if the company, so what's the name of the company? S and D did not know about it, didn't know about it. Definitely it will exist because you don't just stand up and then you liquidate. There will be some signs. You are not paying your short-term debt. You are not liquid. You don't have enough cash sitting in the books. So there will be a lot of signs. There will be all right. Talking about the customer is just about it's just about the um, about them not paying their receivables, them not paying their what receivables, right? So what do we do to it? We adjust it to the financial statement. Non-adjusting event, adjusting event we adjust. Adjusting event we adjust it to the financial position or the financial statement. The financial statement should be adjusted. Should be adjusted. Should be adjusted to reflect the bad debt. To reflect the what? The bad debt. To reflect the what? The bad debt. Right? To reflect the bad debt or irrecoverable debt. Irrecoverable debt. All right. So that is it. Third question.
Illustration 3. Shortly after the reporting date of a major credit customer of the company went into liquidation because of a sorry, I'm taking it again. Shortly after the reporting date of a major customer of a company went into liquidation because of a heavy trading losses, and it is expected that little or none of the 12,500 debt will be recoverable. 10,000 of the debt relates to sales made prior to the year end, and 2,500 relates to sales made in the first 2 days of the new financial year. In the 2021 financial statement, the whole debt has been written off, but one of the directors has pointed out that as the liquidation is an event after the reporting date, the debt should not in fact be written off but disclosure should be made by note to this financial statement, and the debt written off in the 2022 financial statement. Advise whether the director is correct.
To advise whether the director is correct. So what did the director do? Um, Shortly after the reporting date, a major credit customer of the company went into liquidation because of heavy trading losses, and it is expected that little or none of the 12,500 debt will be what recoverable. 10,000 of the debt relate to the sales made prior to the year. So that is between, let's say, what was the date? Did they give any date? Okay, so prior to the year. So 2,500 relate to the sales made in the first 2 days of the new financial year. So let's say the prior year is um, January to December. Is it 2020? Something like that. And then they said 2,500 of the 12,500 relate to the um, period after the reporting year or after the reporting was year. In the 2021 financial statement, the whole debt was written off, but one of the directors has pointed out that so yes, they are not supposed to write the entire debt because the entire debt, part of it relates to part of it is an adjusting event, and the other is non-adjusting event. So the one that is adjusting, we adjust, and the one that is not adjusting and it's material, we disclose. So how do we advise this? Um, how do we advise this? So how do we advise him? So we can see that according to the IAS 10, according to IAS 10, which is an event after reporting period, any event that occurs um, between the reporting dates um, and the date in which financial statements are approved. Between the reporting date and the date in which financial statements are approved, um, so according to IAS, between the date in which financial statements are approved, right? So those events must be what? Must, if there was evidence, we have to adjust those events. But if there was no evidence, then we have to disclose, and it's material, you have to disclose. All right, so we can say that 10,000. So after writing what the position of the law, first of all, write the position of the law, which is according to IAS. So according to IAS 10, event after reporting period, all the events that occur and had evidence must be what? Adjusted for. And those that did not get evidence must be disclosed, right? So you see that 10,000, is it 10,000? Yeah. 10,000 of the receivable amount, the 10,000 of the receivable amount, 10,000 of the receivable amount existed. 10,000 receivable amount existed at the reporting date. At the reporting date. So when you say reporting date, I believe you know that is from, let's say, the example, which is the January to this, existed at the reporting date, and the liquidation of the major customer, and the liquidation of the major customer. The liquidation of the major customer provides more information, right? Provides more information. The liquidation of the major customer provides more information about the receivable. This is therefore an adjusting event. It's therefore an adjusting event which would require the debt at the reporting date to be written off. Which would require the debt at the reporting date to be what? To be written off. Which require the debt at the reporting date to be what? Written off. In which of the financial statements? So 2021. And 2021 is the current financial statement. The 2021 financial statement. Whilst the 2000, the remaining 2000, the remaining 2,500, 12,000 minus 2,500, then you get a 10,000, right? So 2,500 did not exist. That one occurred in the current period. The remaining 2,500 occurred what? To the remaining 2,500 receivable did not exist at the reporting date. Did not exist at the reporting date. Hence should be disclosed. So this one cannot so they give us okay, he said what? In 2020, the whole debt has been written off, but one of the directors has pointed out that as the liquidation is an event after reporting period, the debt should not, in fact, be written off, but the disclosure should be made by note to this year's financial statement, and the debt written off in the 2022 financial statement. Statement. All right. So in 2002 financial statement, what do you think will happen? So that is where receivable did not exist at the reporting date. And therefore should be written off in 2022 financial statement. All right. So that is it for question illustration 3. Move on to the next one. Any question?
Hello.
All right.
Yes, I thought you said the remaining of 500 will be disclosed rather. So I don't understand why you changed it to should be written off later on.
In the current year's period, it have to be disclosed, but in the subsequent years, it will be written off. To the next question.
Swami Limited is a listed telecommunication. Swami Limited is a listed telecommunication company which prepares its financial statements for the year ended 31st October 2015 in accordance with IFRS. The financial statements are due to be authorized for issue on 15 January 2016. Swami Limited holds an investment in the shares of a listed company, 𝒂𝒊𝒏𝒈 Limited. During November 2015, there was a material fall in the value of 𝒂𝒊𝒏𝒈 Limited shares. Analysts attribute the fall in value principally to a fraud dating back to December 2014 that was discovered by 𝒂𝒊𝒏𝒈 Limited's management and announced publicly in November 2015. In December 2015, the directors of Swami Limited publicly announced a plan to reduce the workforce by 10% as a result of worsening economic conditions. Required. Discuss the effects of each of the above items on the financial statements of Swami Limited for the year ended 31st October 2015 in accordance with IAS 10 events after the reporting period.
All right. Thank you very much. So discuss the effect of each of the above items on the financial statement of Swami Limited for the year ended in accordance with IAS 10, right? Event after the reporting period. Event afterwards, reporting period. Event after reporting period. All right. So, hey, explanation. Wait, but that's past question. Let's say the past first. So, let me see. So now, um, so what is the first one? I, right? So I, Xiaomi Limited, right? Xiaomi Limited. So they said that Xiaomi Limited hold an investment in the shares of a listed company, Asafo Limited. So Xiaomi has some shares in Asafo Limited, right? During the November 2015, there was a material fall in value of Asafo's limited shares. Analysts attribute the fall in value principally to a fraud dating back to December 2014 that was discovered by Asafo Limited's management and announced publicly in November 2015, right? So, first question is it an adjusting event to the class? Is it an adjusting event? So, I'm limited whose investment in the shares of a listed company as Asafo Limited. During the 18th, there was a material fall in value. So, fall in value is an adjusting event. Fall in value of your shares is an adjusting event. Hello, fall in value is an adjusting event. Hey, when you are going to acquire another entity, and let's say the value of the entity, one of the share price is 5 cedis. Do you have evidence that after the financial reporting date, this um, share price would fall to say 3 cedis? Is it certain that it's likely to fall to 4 cedis? Do you have some evidence like that?
No.
Because that event occurred, it should occur after the reporting. If it occurred after the reporting date, then you can't say it is an adjusting event. Because what evidence would they have? You see, I think even in the examples that I gave something like that, that the fall in the value of, did I give something like that?
Yes, that one was. Is that evidence of permanent decrease in value of a long-term investment prior to the year end? Please, that's all.
Yeah, and did I place it under evidence of permanent decrease in the value of a long-term investment prior to the year end?
Yes. So it's
Really?
under the adjustment. Yes.
Because fall in the value shouldn't be an adjusting event. Fall in the value shouldn't be an adjusting event. It's a non-adjusting event because it's like it can happen. It's like the way we treat the what's the name, the natural disaster, because it is not certain that what if some people you can buy shares from um another entity and then At the end of a period, it even rise. The share price will even rise. So when it rises, what will it do? If you are saying that a permanent decrease, we even specify that evidence of permanent decrease in the value of a long-term investment. In fact, let's eliminate this point so that it doesn't confuse us. Let's eliminate it because the share price, and here we are specifying that decrease in the value of a long-term investment.
You did make emphasis on you gave an example that, let's say there is a depreciation in an asset. We notice that this asset that the company has been using is falling, its value is falling as the machine is being used. So then, if you say we are taking this off, would you say that that same example will not fit into it?
Then I'm sure the long-term investment that we are talking about is different from the share of an entity, the share price. Then this example will hold if you are talking about equipment in terms of the physical asset. In terms of physical asset, which is the asset that will depreciate. But then, with respect to shares, having shares in another company, that has nothing to do with depreciation. That has nothing to do with what depreciation. So with that, we can't say that that is an adjusting event. But here, then we have to say that it is a physical asset. Then we have to modify this. If this should hold, then we can have to say that we'll modify it to in terms of a physical asset. And decide what is the value of that long-term investment also increase. Would we adjust for depreciation? What do you think? If the value there's a permanent increase in the value of a long-term, what do we do about that? In the question, it is about shares and not about physical assets. So for this point, okay, you can keep it, but the fact that then we have to focus on it that it is a physical asset, so that it doesn't confuse you to this example, to the example that we read. But the example that we read is not a physical asset. It's talking about having a shares in another company, and the fall in the value is like the share price will fall. What I say. So with this, we cannot treat it as an adjusting event. But this statement would refer to a physical asset, and the example that we have, which is Xiaomi Limited. That Xiaomi hold an investment in shares of a listed company, 𝒂𝒊𝒐𝒅 Limited. During the year, there was a material fall in the value of 𝒂𝒊𝒐𝒅 Limited was shares. So here it's share specific. So if you were basing your answer from the example that I gave you, that because of the permanent decrease in the long-term investment, then I'm sorry, because that is talking about long-term investment. That is talking about what? Physical investments, physical assets. All right. Thank you very much. Thank you very much. So here, it is a non-adjusting event because the fall in the share price does not have evidence of its existence, because it can happen. It can happen. It is uncertain. The way we treat the fire and then the natural disasters, that is the same way we treat the fall in the value of the shares. So let me write. So the fall in the value cannot be, it's a non-adjusting event. However, I think that I saw something like fraud. Analysts attribute the fall in the value principally to a fraud right, dating back to December 2014. So the fall in the value is a non-adjusting event. However, the fraud, the identification of a fraud is an adjusting event. It's an adjusting what event. So to the books of Asafo Limited, it will be an adjusting event, which is the fraud. But in the books of which is Swami Limited, the fall in the value would be a non-adjusting event. Would be a non-adjusting event. Are we clear? Do we get this? Okay. So as I'm saying that um the fall in the value. So let me write this and then um oh, sorry. So the fall in value, the value of the shares, the fall of the value of the shares in family in what in Asafo. And the fall of the fall in value of shares is an is a non-adjusting event. Is a non is is a non-adjusting event. It's a non-adjusting event since no evidence existed. Evidence existed full stop. However, to Asafo Limited, however to Asafo Limited, to Asafo Limited, the fraud, however to Asafo Limited, the fraud identified, the fraud identified is a non is an adjusting event, right? To Asafo Limited, the fraud identified is an adjusting what event. It's an adjusting event. To the fall in the value of shares is is a non-adjusting event since no evidence existed. However, to Asafo Limited, the fraud identified is an adjusting what event. It's an adjusting event. So let's read the last question and then I know you are tired. So let's um the next one is in December 2015, the directors of some limited publicly announced a plan to reduce the workers by 10%. By 10% as a result of worsening economic conditions. So is it an adjusting event or non-adjusting event? There was no obligation, right? No legal or constructive obligation existed, right? So it becomes a non-adjusting event because it said the workers by 10% as a result of worsening economic conditions. Did we know that? No, let me not say that. Was there evidence that did we have any worsening economic conditions in the prior period? no evidence existed, right? No evidence existed. Hence, it is a non-adjusting event. It is a non-what adjusting event. So, um, let me see, where is it? I. So, the announcement of plans to restructure. It's because they want to cut down the labor, right? Because of the um, worsening conditions. So the plans, there's an announcement. So that announcement to restructure, um, so that will have an effect on IAS 37 provisions. So it creates a constructive. I believe you have done IAS 37, a constructive obligation. Create an constructive obligation. So constructive obligation to do a restructure, right? To do a restructure. So here there will be what a provision for what that a provision should be recorded. A provision should be what should be should be recognized as at that date. As at that date. The then the end of the story is that it is what a non-adjusting event, but it would have affected IAS 37, which is provisions, right? I don't know whether you did IAS 37. So to be recognized as at that date, right? However, no legal obligation. Let's check the date. hmm So in December 2015, right, the directors, right, publicly announced a plan to reduce the workforce 10%. So you see, this is as at the December 2015, at the end of the period 2015, right? 2015, as at the end was 2015, December 2015. But so it is announcing means you have to make provisions. That's why I said it will be what it will affect provisions because you're announcing you want to make that adjustment. So it will affect provision. So as at that date, as at the December 2015, it has a constructive obligation. It has what a constructive obligation. That is IAS 37. But as at this date, 31st October 2015, there is no legal or constructive obligation. So it did not exist. So the end of the matter is that it shouldn't be adjusted. Let me not prolong it. So it shouldn't be what we recognize as at that date, which is December 2015. But as at 31st October, ah, the date, let me see, for 31st October 2015. In December 2015, is there an error with the date? I'm sure October counts before December, right?
Yeah, so
Let me see. When is the reporting date? So prepares a statement. Okay. So yes, okay, okay. So it was after the 31st October, right? Do you get it? After the 31st October, the reporting date is 31st October. I was thinking it is 31st October, and then they made the announcement as at what 15, as at December 2015, right? So from October, no, from November to December downwards, they are all after the reporting date. After the reporting date, which is 31st December, which is 31st what December. So it makes sense, right? So now, oh, all right. So as at a provision should be made as at what as at that date. But after 31st October, what happens? What happens after 31st October? No legal, no legal or constructive what obligation. Because that is the reporting date. That is the what? No legal or constructive what obligation. Because the 31st October is the reporting date. Hence, no adjustment. Hence, not adjusting event. Hence, not adjusting what event. Thank you very much. So that is how we answer this. That is how we answer this question too. This is um IES 10, adjusting and adjusting. It's just about words, explaining with whether it's an adjusting event or non-adjusting event. Adjusting event. You should know the examples. The example that I gave. Mhm. Then done. Thank you very much, and have a wonderful evening. Enjoy the rest of your evening.